Welcome to Truman State University in Kirksville, Missouri. My name is Colby Bycroft, a graduate accounting major.
My name is Michael Fentress. I'm a senior accounting major.
I'm Philip Eckert, a freshman finance major.
And I'm David Newell, a sophomore economics and finance major.
And we are the Bulldog Student Investment Fund. And we are here today to pitch you the company Halliburton.
First, we'll go over business operations, then the catalyst, management, and finally our final call.
And we'll now start to discuss the business operations aspects of Halliburton.
So hey, I've been looking at companies in the energy sector recently.
Oh yeah.
What can you tell me about Halliburton?
Oh, well, Halliburton, it's a great company. It really is. You know, it was originally founded in 1919. And from there, it went on to become one of the world's largest producers of products and services in the energy industry.
All right.
Now, Halliburton has over 80,000 employees, which then consists of 140 nationalities, and it's in over 80 different countries.
Can you expand on Halliburton's operations?
Oh, well, yeah, of course. If you look at the international expansion of Halliburton, one of the key areas that they plan on going into is the Latin American market. They hope to really break the slump in the Latin American market as far as drilling is concerned. Now, they plan on getting more into Mexico and trying to get rid of the 76-year monopoly that has been that's been held over Mexico recently, and that should increase profits for Halliburton by 25%.
So David, aren't you a little bit worried about the price of oil?
Well, in the short term, we're expecting oil prices to decline again.
Okay.
Currently, about 1/4 of the world's excess production of 550,000 barrels per day are flowing into U.S. oil storage farms. They're expected to be filled in the next couple months. Crushing, one of the largest in Oklahoma, is expected to be filled between April and July. Once that happens, more of the oil will be entering the market, and as a result, push prices down. However, on the medium term, we're expecting oil prices to rise. The International Energy Agency is projecting oil consumption to increase by 900,000 barrels by the end of 2015. While the futures markets is putting the price of oil at around $60 in December, while the United States Energy Information Administration is saying oil costs around $71 a barrel. Our team's opinion, though, is around $65 a barrel in December.
All right, sounds pretty good. You think we're a little bit early for this play?
Well, maybe a few minutes.
Hey David, did you hear that about half of Halliburton's revenues are U.S. based?
And as the dollar continues to strengthen, as central banks from Australia to Canada cut interest rates, and the Fed is expected to increase them, the dollar will continue to strengthen, thus increasing Halliburton's revenue.
Well, that sounds awesome.
So Colby, what really is Battle Red, and how is it going to help Halliburton be more competitive?
So Battle Red was an initial strategy set out by Halliburton in 2011, and what this did was focus on costs of the company. They implemented a strategy that streamlines all the processes from start to finish, directly impacting the costs that are associated with it. This translates directly down to the bottom line to where they're expected to save $90 million per year. In the end, in an industry right now where it's so hinged, revenue is so hinged on the price of oil, cost-cutting natures and features of strategies are very key in making them more competitive.
Is Halliburton doing any share buybacks?
Yeah, that's a good question actually. So in 2012 and 2013, they really focused on buybacks. They actually reduced the outstanding shares by 8%. Now in July of 2014, the board announced another $6 billion in share buybacks. However, this was before the Baker Hughes acquisition. So it would seem that they're shifting their focus on growth to mergers and acquisitions rather than buybacks.
Do you think we're a little bit early for the game?
I think we might be a few months early.
Can you tell me a little bit more about the Halliburton merger?
Well, on November 17, 2014, Halliburton proposed a merger with Baker Hughes, which is the third largest, and Halliburton is the second largest in the oil service provider industry. This would allow them to better compete against Schlumberger, the largest.
Okay, how are they planning on financing it?
Well, they're planning on using both long-term debt and cash on hand to pay for the $19 dividend for every share of Baker Hughes stock, which will cost about $8.25 billion.
Wow, that's a lot.
Well, in addition, they're planning to issue 1.12 shares of Halliburton stock for the owners of Baker Hughes, for a total of, to give the Baker Hughes owners 36% of the new company, which will be traded under the Halliburton name.
What are they planning on getting out of it?
Well, they expect the deal to close in the second half of 2015, and 1 year after the deal closes, they expect to increase their cash flows. 2 years after the merger, they're expecting earnings per share to increase.
Sounds like a pretty good deal.
It's amazing.
So Colby, what do you see in Halliburton's future given the merger?
So what the merger presents is a certain case where you don't typically see. It's number 2 and number 3 company in the industry. merging together, and what that's going to do is put a little pressure on the Department of Justice and other foreign administrations. Is to see whether the results of the merger are going to be competitively fair for everybody in the end. So when you have Halliburton and Baker Hughes merging together,
Let me take a look.
yeah, go ahead. See?
Yeah, I see it.
Yeah. What it's going to do is when you have those two companies together, it's going to be quite influential on pricing power in the overall market. And that's going to be directly related to how Schlumberger is going to be able to compete. So that's what their main concern is. Thank you for taking the time to meet with us, Mr. President. Do you know with this merger, Halliburton is expected to save $2 billion in annual operating efficiencies? They're also willing to sell $7.5 billion worth of revenue-generating assets to make this merger go through. And the clause there is a breakup fee for $3.5 billion just to ensure that the success of this merger happens.
I don't think President Truman's understanding what we're talking about.
I don't think so either.
Can you tell me about Halliburton's business strategies?
Well, yeah, they've got three main ones, but since we're in a greenhouse, we might as well talk about Frac the Future.
What is Frac the Future?
Well, essentially what they've done is that the convoys that they send out for their fracking operations are now running on dual-fuel vehicles. This means that instead of using diesel fuel for their trucks, they can use natural gas that they're producing.
Wait, a green oil company?
Yeah, and the best part is this cut costs dramatically, which is good for the bottom line. It sort of gives them an edge on the competition.
Well, Colby, when you look at all the different programs that Halliburton has, like Battle Red, Frac of the Future, and all the other initiatives, it really comes together to create the Hal Advantage, which makes Halliburton a monster of efficiency.
Yeah.
Could we please have the next question?
Yeah.
So why is Halliburton a buy right now?
Because of management. We ain't talking about operations. We ain't talking about the products. Because of management.
Next question.
Could you please tell me about the merger with Halliburton and Baker Hughes?
Management plays an important part. It's the management that's going to do this. It's the management that's going to make this happen. We ain't talking about practice. We're talking about management. Management.
So, can you please tell me about Halliburton's management?
Sure. Halliburton's management is headed primarily by Dave Lassar, who's been the acting CEO for the last 12 years, been with the company just shy of 20. Mark McCollum is the CFO. He's heading the integration team with Baker Hughes in that merger takeover. And what these two bring to the table is experience. Reminiscent of the most recent oil price decline is within 2001 and 2008. And the position of Halliburton is a little bit different today than it was back then as a result of management.
So you mentioned about the integration with Baker Hughes. Could you elaborate on that?
Yeah, so like I said, Mark McCollum is the acting CFO. He's leading this team, and their drive is to make this integration process more complete and easier for both companies going forward. What they're going to do following this March 27th meeting, if both companies approve the deal, is that they're going to be able to take their work that they've done right now and hit the ground running, so to speak. And it makes for an easier transition and implementation of the two companies together.
So I've been reading that oil companies are cutting their capital expenditures. How is Halliburton handling that situation?
So Halliburton's management, as you said, CapEx budgets are being pulled back significantly to the tune of 25 to 30%. And management's doing a significant role, playing a significant role in that and being able to manage how much companies are spending by maintaining constant contact with these companies. They're calling their clients nearly every day to make sure that capital budgets are going along as planned. And if there are cutbacks, then they're going to be able to quickly take action to figure out where management needs to make decisions. So as we begin to summarize the overall pitch of Halliburton, we want to focus on valuations. And in this instance, we took three valuations into account: a discounted cash flow model, a multiples approach, and a pro forma merger approach from both Baker Hughes and Halliburton. From a discounted cash flow perspective, we valued the standalone company at just over $49. From a multiples approach, we value the company just under $50. And from the pro forma approach of the integration of Halliburton and Baker Hughes, we value the company at $63.57.
Based on our research of Halliburton's business operations, the catalysts they're facing, and what management will contribute, we are suggesting a limit buy order at $40.
So Colby, aren't you a little bit worried about the price of oil?
No, I think the way Halliburton's positioned operationally, I think they're able to withstand the recent declines in oil prices.
Huh, it must be a sign.
I think it is.